Hi everyone. Hopefully you're doing fine today. I got Mike Newman.
Yes, sir. Newman.
And we call you Mike.
Yes.
All right. Mike has a wonderful product that I came across on his website, a number of his videos, and I think he shares a similar background into coming and actually using a HELOC and then moving on to a different level. He's also an investor, also has a partner that's on board. So take it away, Mike. And if you can explain your product, my audience already know what me and the HELOC, but not this all-in-one product.
Yeah. Yeah. So thanks again, Willie, for having me on. I'm going to do my best to verbalize and explain, and then we're going to run through a share screen where I'm going to go through a simulation for you, and you're going to help me with that on the input. So basically, in a nutshell, this is a first lien HELOC that's fully integrated with a checking account. So literally, our checking account comes with full integration into a first lien line of credit, which becomes your mortgage. And what that means and why that's special is the moment you deposit funds into your all-in-one checking account, it is pushed to your line of credit, meaning it pays down your line of credit. So if you owe 400,000 and you bring in 10 grand and you deposit that 10 grand, it will push that 10 grand to the balance of your line of credit, thus reducing it to 390. Your interest calculation is made that night at 9 p.m. West Coast time, and swept away, and we start again the next day. So your interest calculation is now something you can control based upon your discipline, your income, and how you work your finances. And so this is a true sweep account. As you inject money in, it's pushed to the line of credit. Like I said, interest calculation has happened every single day for a full month, and then we make an interest-only payment as a draw on that same line of credit on the 21st of the following month. So it basically, in essence, snowball pays off your mortgage. But the other great part of it is you are fully liquid. Every dime you're putting into this is fully accessible throughout the length of the loan. So, in a nutshell, that's what's going on. It's hard to really grasp what that does and what that can do because there's a major compounding effect that happens. But in essence, my average simulation is inside 15 years of mortgage payoff. And a lot of them, depending on people's finances, of course, are inside 5 years. And that sounds very, that sounds very like impossible. But as you will see in a simulation that we can share here, it is absolutely possible. You still with me?
Oh, yes, Mike.
Okay.
All right.
So I'm going to share my screen here. So give me just a moment. Um, okay. So tell me when you're ready. And
Okay, I'm ready.
I've
Let's
got my
go.
screen shared here, and let's make sure that your audience can see the screen, and we'll run through a simulation.
Okay, ready.
Okay. So, as you can see, this is on my website, on our website. It is for anybody to use. Obviously, you got to know how to use it effectively, but it's pretty simple and straightforward. So this kind of gives some information in regards to the all-in-one home loan. By the way, this has been around for 20 years. This is not a new loan. This concept came from Australia, New Zealand. We took us about 3 years to roll this out, so it's not new. It's just starting to grab some wings as people are looking for a different way. As the average American with a mortgage is 55 years old and they have 25 years left, and that's a problem. So here we are, all in one. We're going to run through a simulation here. So I'm just going to do start a new simulation. And we're going to do this. I'm going to let you tell me how you want to do it. We can do it as a
Let's do a
purchase.
purchase.
Okay. And so obviously we can do refinance, and also it's a custom construction loan as well. So just so you know, one-time close. Occupancy, we can do as a primary home. We can do it as a
Primary.
second home or investment. Primary. Okay. And we are going to compare this up against a new traditional loan. So what I'd like to do is compare it up against a regular good old-fashioned 30-year fixed Fannie Mae type of loan. And we'll be really aggressive in regards to what kind of a rate we could get on the 30-year just to give that 30-year every advantage we can give it. Okay. So
Okay.
give me a home value. What are we purchasing for?
350,000.
350.
And I'm in the
Okay.
first year.
Nope. Okay, so 350,000 is this person. So the all-in-one requires a minimum of 10% down payment. Obviously, like most loans, it's more expensive at 10%. So 20% is ideal. How do you want me to do the down payment?
10%.
Okay. Okay, so that's going to leave us with a balance of 315. We're going to compare it up against a 30-year, and let's say we got really fortunate and we got a rate of 6.25 in this day,
Yeah.
this current climate. Okay, so what this is telling us, Willie, is this is telling us that our principal and interest on a 30-year fix at 6.25. So again, the main part, not counting taxes and insurance, on a 30-year at the 6.25 is going to be roughly $1,940 a month. Okay, that's what that's saying. Okay, I'm gonna click to this next screen. Now we got to get into some financials. So tell me, what is this person bringing in? And let me make this clear. This is not gross, this is net. So this is what's hitting this person's account, and that is extremely important. The more that hits the account, the better. Okay, so this is where I have conversations with people about what they're doing with their money, where it's going before it hits their account. In other words, what their employer is pulling out, or if they're self-employed, what they're setting aside for quarterlies or whatever it is. That all plays an impact, because now this is going to change our calculation. Whereas in a regular loan, it doesn't care. Doesn't care what you're doing out there with your banking or whatever. The mortgage is coming and it's due. Okay. So this person, what are we putting into their account? What are they making?
I have rental property, so my income from my employer, 4,500. I'm adding it up now, and about 3,000 rental income.
Okay, so stand by on
7,500.
that. So we'll do 4,500, and is that coming in monthly,
Mm-hmm.
once a month? Okay,
Mm-hmm.
so we'll go monthly.
No, I'm sorry, bi-monthly.
Okay,
Total
so
per month.
I need to divide that out.
4,500 divided by 2.
Yep, you got it. Okay, so 22,250, and then we'll go semi-monthly. Okay, and then I'm going to go down here, repeat deposit, and you said rents are going to be
3,000.
and again, is that gross rents?
Gross.
Those are the rents you're bringing in? Yep.
Yes,
Okay,
gross.
perfect. Okay, and so obviously those are monthly. Any other deposits?
No, I'm gonna go no.
Okay, so we'll start there. So I'm going to point this one-time deposit out. Once people actually realize what's going on with this loan, they'll realize that all this money or money that we have in savings accounts, reserve accounts, even money markets, those things are there and a good idea to have there. However, they are not doing much for us. Maybe a money market's given us a little bit of a return, but it's not doing a ton for us. We put these things in these other accounts because we need liquidity and access. But as you start to register what's going on with this account, we realize, well, we are gaining liquidity and access of those funds. But if they're injected into the all-in-one checking account and thus pushed against my line, we now have full access, yet we are benefiting from that savings and interest. Okay, so I liquidated all of my accounts almost entirely and have put them in my all-in-one account. So that's where we would put a one-time deposit. I don't want to do that yet because I want to do this really conservative to begin with. So this is kind of coming all together. This person has an average deposit amount annually of about 90,000 a year. Okay, so we'll click to the next one. Now, this is our spending page. How much are property taxes and insurance on this property?
On this particular property, I'll say 3,000, 4,000. Don't have the exact amount, about
That's okay. Yeah, this
4,000.
is all estimating.
Just
4.
4,000 taxes, insurance, yes.
Okay. So we're going to lower this down to about 335, give or
Hmm.
take. Okay. So now what this says is it's taking our deposits, adding them up. Okay. This says the principal and interest is right here on a 30-year fixed. Okay. And it's setting aside the taxes and insurance. So the first major difference is taxes and insurance are not included in our payment on the all-in-one. Okay. It's not even allowed. Why is that? Because it works against what this is all about. This says we want your money working for you 11 months out of the year, and you're going to pay your own taxes and insurance on your own because you're disciplined enough to do that on your own. If you're not, you don't belong in the loan in the first place. If you are, you're going to want that control, and that's a beautiful thing because it's going to save you a lot of money. So what we're saying here is principal and interest and taxes and insurance are now taken out of this 7,500 because we're assuming that you'd be spending that anyway. It's leaving us with about $5,200 left of money. If I don't do anything here, this isn't going to make sense, and it's going to show that you have expenses above and beyond a mortgage of $5,225 a month. Okay, so hopefully that's not the case. So now I need to ask, what are expenses? So what are your monthly expenses? Bills, food, cost of living, expenses on the rentals and that kind of sense. We put in 3,000 for those. So what is our monthly
22, I would
expenditures?
say 2,200.
Okay. So then I take this guy and I arrow that up until that average monthly expense outside of mortgage, because we've already accounted for mortgage, is roughly 2,200. Okay, which would mean we've got roughly $3,000 left over at the end of the month. Is that fair?
No, so I need to have definitely not that. I'm usually having about 12 to 1,300
Okay.
left over.
Okay. So let's change that
Yeah, let's go with 500 left, 1,500 left over, if you can bump that up.
right there. Okay.
All right.
Ready? Here we
Yeah.
go. Okay, so here's your side-by-side comparison. Again, to be fair, remember the 30-year is just the 30-year. It's not assuming you've paid any extra principal. Okay, you can, but let's be honest about what's happening with extra principal. Is it wise? Absolutely. Do most people do it? No. 4% of Americans actually consistently reduce their principal on their mortgage. Why? Because it's not changing their payment and it's locking that money up. And what if they need access to it? Okay. So, but I want to be fair here. It is not accounting for any extra principal payments, which we can do that in the simulation, but we didn't do it. So this is a side by side, and what this is saying is, based upon what you gave me, you're leaving that 1,500 in there, and it's compounding its impact on your mortgage, and what that will allow you to do is pay off in approximately 11 and a half years compared to 30. And the best part is, look how much money has been saved in
Mhm.
interest.
Wow.
Okay, over $225,000. Okay, so your interest is only about 100, and we'll call it 158,000 versus 383,000. Those are
So,
sobering.
so I did
Um,
not buy the bank an extra house.
That's right. Yep.
Okay, okay.
And so the bottom line is we for me, I didn't, I've done mortgage lending for 20 years. I had no idea that this loan even existed until I made a move to CMG Home Loans in November of 2024. Okay. And so ever since then, and I learned about it, I can't unsee this loan. I didn't realize that there was a way for me and my clients to potentially control their mortgage. We have more money that rolls through our bank accounts, the average American, in a 3-year period to pay off our mortgage in full. So now that money that we put into our account, instead of doing nothing for us, we are becoming the bank. We are becoming the controller of our destiny ultimately, and our discipline is rewarded. So for me, I run my life, believe it or not, on credit cards. Okay. Because I know how disciplined I am. The credit card companies believe that I'm not going to be that disciplined. And so they bet that I won't be. So they give me airline miles or whatever it is in turn. So I take that bet. and I use credit cards all month long for my expenditures as much as I can. And I pay auto statement balance in full. I don't pay a dime of interest, okay, ever. And so what happens is with the all-in-one is my all-in-one account has no clue that I'm spending money all month long. Why is that important? Well, because my calculation is being made on my deposits. And if I'm not taking money out of that account for the multitude of the month, then I'm saving, even though I'm saving more and more and more every single day, only to towards the end of the month, my statement balances get paid and my balance goes up a little bit, but it never goes back up to what it was to begin with. It goes up a little bit. And so for a couple of days, my interest calculation goes up, but it's only for a couple of days because I get paid again and then it drives it back down once again. So that's called achievement. That's called overachiever inside a mortgage. And this mortgage cares about that. So if you're an overachiever, you can tear this thing up. It's amazing. Whereas the regular mortgage, I'm not trying to talk bad about it. I've done
Mm-hmm.
it my whole career and I continue to do it. And it's a great fit for a lot of people. But for those of us who want something more and want a little bit more control or a lot of bit more control and want freedom in 11 and a half years or less, this is mind blowing. Now, it's a vehicle. You've got to
Now,
drive it.
I don't know
So,
how much you know about on the credit side, but at least with some of my audience, I'm looking to improve their credit. So
okay.
this hitting your credit report will hit it as a revolving line of credit or a mortgage.
Well, it is a mortgage, but
Mhm.
it is a revolving line of credit. So, yeah, so it's kind of both, but it is not installment debt. It is revolving.
Okay.
Mhm.
And if you understand, would it have an impact on my utilization? So if I put a $315,000 line onto my credit, I'm at 150%. I mean, I'm at 100% day one or month one, right?
Mhm. Mhm.
So
Mhm.
that's going to hit my utilization.
Yeah,
Oh,
and I got to be honest, I'm pretty good with credit, but I'm not an expert.
no,
And
no way.
I don't know the if it's treated the same way as what a credit card revolving debt would look like as
Okay.
far as what
Okay.
you're saying. So um yeah, so again, I got to be honest, this is not this loan is, we have minimum credit score requirements.
Hmm.
It is harder to qualify for this loan. The beautiful thing is sometimes people come to me and they're not quite ready for it, but we can build a plan to get them
Okay.
ready
Okay.
for it. And again, it's all about discretionary income. The
Hmm.
more excess income, discretionary meaning I'm not rubbing two pennies together. I have extra money. Whether I'm spending it or not is up to me.
Hmm.
It's not spoken for. Now I could spend all of it, okay? And there's that discipline thing. At any point in time, somebody can turn on discipline if they choose. It's
Okay.
that is their discretionary income left over because this is not a magic button. This
Hmm.
doesn't magically pay off a mortgage. It takes money to do it, and it takes the discipline to do it. The great thing about it is it's so simple. All I have is automatic ACHs set up. It's feeding my all-in-one account automatically, and I have my auto pays set up, and it's literally set it and forget it. I am not pushing around money
Hmm.
anywhere anymore. I don't need to. It's just feeding my all-in-one and letting it work. And then for me, I'm repositioning myself for the next investment opportunity. And the more I drive it down, the more I have access to funds to make that happen.
And
So it's pretty wild.
And touching on investment, one of the things that really drove me to your website was your real world experience with actually having it. Touch just a little bit on that.
Yeah. Yeah, this is not something that I'm just out telling people about and said, hey, this would be good for you, but I don't have it. I have not only do I have this on my primary residence, but I also have purchased an investment property with it. Okay. And the reason being is, so why do I have two of them? Because in essence, I'm kind of dividing my efforts. But my situation is one where I have other investment properties. Those investment properties cash flow. Okay. So they cash flow today. When I evaluate an investment property right now, And most people are in this position and realize that they don't cash flow very good. Why? Because interest rates are up. Okay. So when you look at the math, they're not cash flowing so good. So when I thought about, okay, but what if I do the all-in-one on this investment purchase and use my rents that I don't treat as income? I'm not living off of, I'm fortunate I make enough money here doing what I do. Okay, so I'm my rents are, I treat them as if they're future. So I put them down on principal, I put them in reserve or whatever it may be. So I thought, well, shoot, if I use those same rents to put into my all-in-one, which is thus driving my balance down, and then my interest calculation is going down, which means my payment's going to go down, which means month two, I do cash flow. And the more I cash flow, the more I pay down. And the more I pay down, the more I cash flow. And now you see. So it's a magical thing that is working for me. So the more I feed it, the more cash flow happens. The more cash flow happens, the more I feed it.
Now,
So it's a
remember the other,
no-brainer.
as an investor, I have multiple properties also, but I would like to maybe bring them all into one loan to pay them off quickly. Is that
Yep.
possible?
It not yet. So we don't have a what we would call kind of more of a cross collateralization or all encumbering. We're working on that, but it's not
Okay.
out today. So, but what you can still create the same mechanism. So what I would recommend for somebody in that situation is pull the trigger on the all-in-one on your biggest lever. Okay, meaning typically it's a primary residence. Okay, so the biggest lever is your biggest equity position and biggest access to equity. Okay, so what happens is you if you're fortunate enough to have a lot of equity, so now you've got access to those to where if you can pay down that all-in-one enough to where you have access to enough to pay off one of those investment properties, then you do that. So you
Okay.
work on the all-in-one, drive it down until you have enough equity to pay off that first investment property.
Okay.
You pay it off, you pull that into your all-in-one. Now that's complete cash flow. That's turned up your cash flow and turned up what you can put in the all-in-one. Now you just sped up, even though you just borrowed more, you just sped up the engine. Okay, so then you do it again and you drive it down faster.
Oh,
Now you've got enough
wow.
in there, you gobble up the next one. So you can still do the same thing. It's just not all at once. So your efforts are focused, getting it down, gobbling it up, putting it in. So it's just kind of a revolving door until you've got it all under that one umbrella of the all one. And all of that cash flow is now full
Okay.
bounty, just working on that engine. Yep.
Now, do you have any of the product? I'm looking definitely at the all-in-one. Does any of them have direct deposit? So from my employer directly into the all-in-one, no additional movement.
Yeah, so that's literally what the all-in-one is. So the all-in-one, as soon as you close, well, within 30 to 45 days, your accounts get set up. You get debit cards, you can order checks, okay? But as soon as you close and as soon as it gets set up, and all the bank is all set up, you set up your ACHs just like with any other bank account you would do. You would set them up to auto deposit into your all-in-one account, and then you can set up external relationships with outside banks. You can set up you can do wire transfers, all the same things we're used to with normal banking because it is
Okay.
normal banking. It just happens to be integrated with that line of credit.
Okay. And as we wind up, can you just give us again the credit possible, well, not possible, but maybe the requirements?
In regards to like credit scores.
Yeah.
Yeah, so it's gonna kind of depend.
Oh, I'm sorry.
In
Just the general profile of
Mhm.
coming to you. I'm sorry. Yeah, something
Yeah,
like that.
if I was to give you kind of a boilerplate, all encompassing, I'd say 700. There is
Okay.
circumstances where it needs to be 720,
Hmm.
depending on somebody's qualifications. Say it's a self-employed person that doesn't qualify, they're writing too much off. We can't qualify them on regular tax returns, so we have to go to a bank statement program where we're excuse me, income calculation, where we're actually using bank deposits on this. So that makes it kind of turns up the dial on the qualification. So that makes credit scores need to be higher and reserves to be a little higher. Debt to income
Okay.
changes. So again, just like any other loan program, there's caveats and twists and turns depending on credit profile and the whole picture.
Hmm. So, well, thank you very much, Mike. Really appreciate you coming on and the time. Thank you for the real world experience and meeting someone who actually is using the product and able to talk about it, the experience you had in the industry. You saw what was going on. Now again, let's go back to you moving over to CMG. Did you move over to CMG as a loan, or you went over because of this product?
Yeah, good question. Actually, I did not move over because of this product. This was
Okay.
icing on the cake. I moved over for a lot of reasons. I didn't even
Mm-hmm.
know about the all-in-one until I got kind of settled in and figured, gosh, I should probably learn to do what we can do that nobody else can do.
Uh-huh.
And then I started learning about this, and it took me a second. But
Mm-hmm.
once the light bulb went off, I went, oh my gosh, this is it. This fits my model of education and how I work with my clients and
Mm-hmm.
strategize, because I'm not just a loan officer. I market myself as a strategist at this point in my
Okay.
career. So this worked perfectly. Now, again, is this for everybody? Absolutely not. We have almost 1,000 loan products. So I've got something for everybody. But this
Mm-hmm.
just happens to be something that's so different. And I think people need to understand that there is something different
Oh, yes,
out there.
yes, yes.
There's a different way. Yeah.
Starting from the principal is just, wait a minute. I could have started off at 230,000 and actually immediately, and the cash flow, my rental income, my consulting income, I had some pennies in the ashtray, everything
Exactly.
seemed like I can put inside of this all in
Yep.
one and help me with the principal.
When you start to really grasp this, and this is what my clients that I've been doing a lot of these have shared with me. I got one guy that's just on fire, and he called me real excited. He's like, I literally look around, Mike, at what I haven't used for a long time. And I'm like, if I sell that and I put that in my all-in-one, it's going to me immediately. So
Mhm.
he's constantly, and then when you're rewarded for keeping your money in longer, because the longer you keep your money in the account, the more your interest calculations is going down. So you think about that, and that causes you pause in spending money. At least it does for me.
Mhm.
It's like, well, if I spend the money, then it's going to change my calculation and it won't be as good. So it
Yes.
causes you pause instead of just, doing what you do. So it's crazy to think about something that is principally first being paid when we're so used to
Mhm.
an interest heavy mortgage, and that's really what it is. And then the freedom inside of that, and here's really what I share with people that's really I think powerful. So the mortgage, a regular mortgage, and again, not talking bad about it,
Mhm.
just reality of the mortgage. Okay, the regular mortgage does not care if Willie makes a lot of money. It also doesn't care if you don't make a lot of money. Okay, if you have a unforeseen financial situation happen
Mhm.
medically or whatever with your family, it doesn't care. It's coming. It's relentless. It's coming the same amount every single month. Okay, it doesn't care about any of those things. However, the all-in-one says, okay, you get real disciplined and you pay this down for a few years. Now you've got this gap between what you owe and what your line of credit is. And that gap is access to funds.
Mhm.
Okay. So that's freedom. So what happens is if life throws the curveball, you're able to not go into freak out mode and have to maybe lose your house or whatever if you didn't have
Mhm.
the savings. Yeah, you do. It's right in there. But that savings is actually saving you money in case you never need it, right?
Yeah.
Because our savings account or reserve account that we've all been trained to have, which is smart, but
Mhm.
it's in the bank. And what is that benefiting? The bank. What if you
Right.
never have the emergency? What is your loss in opportunity
Mhm.
savings? Huge. So this is going to work for you. And the other example I like to give people is how many people do we know? got into a career and they're miserable in this career, but because the rent or the mortgage is coming relentlessly every single month, they can't
Yes.
make a change. And so they do what they do. Whereas with the all-in-one, having this calculation that's happening and having this gap, they could go, you know what? I'm going to hit the reset button. I'm going to do something different. And it's going to take me 6 months, but my equity is going to make my payment for me while I get myself back on my feet. And then I'm going to be a happy camper. I'm going to be doing what I want to do, and I'll get myself back in order again. Okay.
Well,
And that's freedom.
well, I definitely like hearing that part as we conclude because we're looking at some of the layoffs with the major companies. So this all-in-one seems like it can definitely give you some breathing room for a few months to get back onto your feet without the mortgage pressure or the bank writing you the letters.
Yeah.
You don't have to come back and requalify. You can circle the interest only. Well, Mike,
Yep.
thank you very much for your time. Really appreciate it. Really love hearing your real world experience and seeing a professional that has actually used the product and they're just not out here theoretically talking about it. Can you throw your
Yeah.
contact
Yeah.
information up there on the page for us?
Yeah, so I'm trying to think of how I can give you my contact. I'm just going to verbalize it to you, and I can send it to
Okay.
you. So my contact information, people can contact my team and I at 541-227-2727. Okay, that's our line, and then we can be emailed at Newman Group. So Newman is spelled Newmann. So Newman Group at cmghomeloans.com. And yeah, I'd love to hear from you guys and check out my socials. I'm on LinkedIn, Instagram, Facebook, YouTube, starting to get more YouTube videos out there.
Yeah,
A
yeah.
lot of podcasting all over the nation done in regards to this concept. So love to connect.
All right. Well, thanks, Mike. Really appreciate it. Have a great day, guys.
All right, you too. Thank you.
Bye bye.